Well, the stock market's had a pretty rough month or so. So I wanted to speak to you a little bit about what's been going on recently and what we see forecast for the upcoming months. This year has been a rough year because we have 4-decade high inflation. We've seen conflict in Europe with Ukraine invasion with Russia. Supply chain issues are still continuing on and will probably continue on here through the year, and potential recession in China from their shutdown from coronavirus, and Europe struggling with their economy. The US economy is actually one of the strongest in the world right now. So all these have really had a drag on our stock market. They've also started a 50 basis point increase or a half point increase in interest rates. That's the largest increase since the year 2000. All this is in reaction to the fact that inflation has been very high. So there's been a lot of negative. This has actually caused the S&P to be down about 20% so far this year. The NASDAQ is down even more like 30. Even long-term bonds are down 20% this year. Now, we discussed a lot of these topics back in our webinar in January with our State of the Market, and we had three major themes for this year and three major things to be looking at. Number one was I called 2022 the year of volatility. Certainly that is coming to pass. Lots of up and down. It'll probably continue throughout the year. Fortunately, we're likely at a low point right now with positives to come is what I'm thinking, but it will take a while. So I'll explain that in a bit more detail. We also talked about bonds and how bonds are not going to be good investments during a rising interest rate environment. We have certainly seen that come to pass. The bonds have been going up for 40 years because interest rates have been declining, and now we've seen that reverse. Not only that, but we are not seeing negative correlation to the stock market with bonds, as I said would happen. Bonds are going down right alongside stocks. Thirdly, we talked about commodities and how commodities have been in a down cycle here recently, but it would reverse because the valuation on commodities was so extremely low at the time and had to rise. We've also seen that come to pass. Commodities are up over 30% this year as a whole. So all three of those topics were actually right on point. Lots of volatility, bonds not being a strong part of the portfolio, and commodities being a stronger sector. Fortunately, within our portfolios, we are always well diversified and we have strong commodities exposure. We've really limited our bond exposure. And of course, we have guaranteed investments as well within portfolios for periods of time like this to prevent losses. So overall, we've done very well in comparison to the stock market. You should all rest easy that we have a plan in place for these volatile times and things will improve. Now, what are we seeing moving forward? So I'll ask you a question. Do you remember what the stock market did toward the end of 2018? My guess is you probably don't. But during that time, about 3.5 years ago, there was a lot of talk about rising interest rates potentially and that impacting the economy and things like that. The market, the S&P 500, actually went down 19.8% in late 2018. But guess what? You probably don't remember that because within 5 months, it had actually recovered back all of those losses. This is how the stock market works. We have these periods of time that are down and periods of time that are up. But oftentimes you don't remember the down periods when the recovery happens. I don't anticipate this being exactly like 2018. We're going to have a longer, more volatile rise from these lows, but there's a lot of positive that we can see moving forward. Really, being a contrarian, when you look at things, all the headlines are bad. This is actually a really good sign. Because if any of these things lighten up, that will have a positive impact on the market. So for example, if we see Russia pull back, that'll be very positive. Supply chain issues eventually with shipping should get cleared up here as time moves on and China opens back up. With coronavirus weakening, fortunately, 4-decade high inflation appears to have peaked. Now, certainly prices are not going to be declining from here. However, inflation is probably not going to get any worse than where it is now. So we've got a lot of upside here. The other thing is that I was much more nervous when the stock market was more expensive. The price to earnings ratio in the stock market toward the end of last year was above 30. Historically, we see that usually around 15 or 16, but it's higher when we have these lower interest rate environments. The forward price to earnings ratio right now in the stock market is in the 16s. So it's not expensive. The market's actually not expensive anymore. So these are all good signs that we could see moving forward. Another thing that I find very positive is people are actually more negative on the stock market right now than they have been in an extremely long time, 30 plus years. They're actually more negative now than they were in 2018. Now, when that happens, what does that usually mean? Well, people's instinct is usually wrong. People usually get it wrong. So that very well could mean that we have an upturn from here. So I feel very good about where we are. We've already taken, losses in the market. When the market goes down, there's actually less risk in the market. Market risks drop as the prices drop. So hang in there. We're going to be fine. We just have to go through a volatile year. But just know we're watching things for everyone. And if you have any questions, feel free to reach out to us. 248-385-2385. Of course, you can speak with me or any one of our advisors here if you have any questions or anything we can help out with. So hopefully this was helpful and enjoy our upcoming summer.